Hi, everyone. It's Andy Tanner here, and I'm joined by my two great lead faculty guys, Corey Halliday and Noah Davidson. Corey, how are you?
Doing great.
And Noah, how are you, my friend?
I'm just trying to get used to being called the faculty.
I was such a bad student that my teachers would roll over in their grade if I called myself faculty. Hey, we're going to talk about oil. And we were just sharing ideas as friends and what we talked about. We thought, there's probably a lot of students that would like to have a lesson on the oil thing and the USO and the ETF and what is contango and what is backwardation and what are all these crazy things and why is this nuts and what should I do and all this. We won't tell you what to do because that's a good segue. Don't you think that's a good segue into a disclaimer, guys? So let's erase this. And my timing wasn't good because we don't provide advisory services. We're not going to tell you whether to buy oil or not. But we are going to give you some examples that are, illustrative that might help you understand not only oil a little bit better, but ETFs a little bit better, future contracts a little bit better, some of these financial instruments better. But I will tell you this, I'm going to start off with the big picture. I'm going to talk about the emotions of trading and some big picture stuff. Then we'll go smaller into some granularity. And define some jargon, right? Because as long as you're using words that people don't understand, we got to give this stuff some mass. We got to give this an ability for people to understand. If I use the word contango and people don't know what that means, they'll tune out, and it's of no value to them. But if you listen very carefully, and we can get a big picture idea, and then smaller picture, and then we'll go back big at the end. Sound good, everybody? Okay, here we go. All right. So the first thing I'm going to start with is a bigger picture context of just investing in general. And I'm going to bring my little white board over here, and hopefully that shows up and works. Let's see. Let's test a little scribbled. Yep, it does. And we'll just say that this stuff is risky, and we make no warranties, and we do this financial education only, and we don't give advice. We're not advisors. And so with that, I think we're pretty much on the same page. So I'm going to share with you a couple ideas about investing in general, and we're going to talk about greed. We're going to talk about panic, okay? And then over here, we're going to talk about education, okay? And we're just going to use some common sense stuff right here, okay? First of all, what is greed? Greed is a type of fear. And it's the fear of losing out. How do you spell losing? I don't know how. Losing out.
You nailed it.
On opportunity. If there's a chance, and this is how con men work, right? Opportunity, however you spell that. In other words, this is how Bernie Madoff got people's money is, you feel like, God, you have a real fear that if you don't buy, you miss easy money and you miss something out. And if you go back, through the history of mankind, up until the last 100 years or so, most of us were farmers. And before that, we were hunters and gatherers. You think about your great-grandparents or your grandparents. Did you guys have grandparents that put up their own pears and put up their own stuff in the cellar and put up tomatoes and all that stuff in the cellar?
Absolutely.
Oh yeah.
Grandma and Grandpa had a cellar and they grew their own food in addition to what they got at the grocery store. Yes.
Yep.
And so the idea of a Garden of Eden is a pretty cool idea biblically for most people, because most people that read the Bible had to work hard for food and, toil and sweat of the brow will I earn thy bread. So the idea of something for nothing, an easy score, food without toil, that is greed. That appeals to everyone, that I can just get a big score. I can win the lottery. I can win a slot machine. And the reason that a lot of people will buy something they shouldn't buy is they don't want to miss out on a payoff. They have a fear of losing out on what could be. Panic is fear. Panic is fear of losing what you have. And so a stock starts going down and you sell because you want to sell before you lose any more. So this makes you buy out of fear, right? And this makes you sell out of fear. This is the Garden of Eden. We really want something for nothing. We love the idea of getting something without a lot of work. A small amount of investment and a big score, right? I don't want to lose out on the big score. This is how Bitcoin works. Right? People, what a currency is, all a currency is a medium of exchange. A currency is just supposed to be like something I use to buy and consume stuff. People looked at Bitcoin because of the price going up and down, not because they thought, oh, this is a cool way to buy stuff. I'll get some Bitcoin and then I'll spend it, right? No, they said, I'm going to get Bitcoin as an investment because I'm scared that it'll go to $17,000 a coin without me. So people buy, oh, I'm going to sell my Bitcoin because it's going down. Follow? Greed and panic, right? That is the big deal right here. So I'm just going to say that if you see USO or oil getting cheap and you want to buy it because you're afraid that it might go up without you, are you really investing with a sound mindset? And if you own some oil and you're selling it out of fear, is that really the reason to sell? Now, I'm not saying that you shouldn't buy or that you shouldn't sell. I'm just saying that these are not reasons to buy and sell because there's no logic to them. These are all emotions, and we want to get that out. Another thing is education. Here's a question for you. Should I invest in things I don't understand if I don't get it? Is it a good idea for my mom to invest in E-mini futures contracts on the S&P if she doesn't even know what they are? Is it a good idea for me to invest in real estate if I don't understand it? This is where the education continuum comes in, because being aware of the real estate market is not the same as being competent, is not the same as being proficient. Simply moving from ignorance to awareness of gold doesn't mean I'm proficient in gold. So a lot of people want advice and they say, well, should I invest in oil right now? Or should I invest in real estate right now? Or should I invest in paper assets right now? It's not about which asset is best. I can find winners and losers in every asset class. Anyone that says real estate is a bad idea needs to argue with Kenny McElroy and Robert Kiyosaki. Anyone who says stocks isn't a good idea for investors, they got to knock on Warren Buffett's door and tell him he's an idiot. Anyone who says investing in energy is stupid, the late T. Boone Pickens might roll over in his grave and disagree. And anyone who says businesses fail 8 out of 10 times, therefore it's bad, has to talk to Mark Cuban, Richard Branson, Bill Gates, and Steve Jobs and tell them that they're all morons. And so what we're here to tell you is, as a context of when you see this stuff with oil, this is not a reason to buy it, and this is not a reason to sell it. This is what we want, and this will elevate the financial well-being of humanity. This will, not this, this will elevate your financial well-being. Anything you guys want to say on that before I move on into a different context? That's it.
I really enjoyed that explanation, Andy.
I did.
Probably too long-winded, but we didn't practice this.
I think temperament is very important. Your temperament, as far as if you ever feel just anxious and like you're going to miss out, that's telling you something. I've never met anybody that makes a lot of money because they panic better than everyone else. I've just never found that, right? So if you panic, whether it's buying or selling, you're not making good logical decisions, and you're not going to be a wealthy individual through buying panics and selling panics and chasing the latest craze and so on. So that's my comment, is temperament is very important in this business.
Well, I'll add a comment to that, Andy. You and I have spent a lot of time studying things about the brain, how the brain works.
Yeah.
And what comes to my mind is just how primal these emotions are. That they're really in, I don't know which part of the brain it is, the medulla oblongata or something, the limbic system. Yeah. Yep. It's such a human nature thing. It's just part of our human nature to have those emotions of of fear and panic. It's the ability to rise above those lower base impulses.
Yeah. It starts with being present and awareness, right? Being conscious, being present and aware that all of a sudden it's emotional awareness. Oh my gosh, I'm feeling greed. Oh my gosh, I'm feeling panic. By being aware, then that helps us deal with them. Great comment, Noah. I assume everyone knows who you guys are, but in case this falls into the hands or video that someone doesn't know who you guys are, let me introduce you guys. Some of you guys know me. I'm a student of investing, and what I try to do is surround myself with smart people like Noah and Corey who really know what's going on. But I'm pretty good at making things simple for people. I'm not as good as some of my mentors, but I do my best. And that's why we have the Cashflow Academy, is to make this type of stuff simple. And then Noah is what I would call a trade adjuster. He's primarily an options trader. How long have you been doing this, Noah? About 20 years?
Almost 20 years, yeah.
About 20 years. And his specialty is trade adjustment. And then Corey, you're an options principal. Just talk about what an options principal is real quick.
Yeah, so it's Series 4 license is basically the head of option trading. So at the firm. So that was my license and designation.
So you're in charge of managing the risk of how many hundred traders at the firm?
Yeah, hundreds of traders, and basically overseeing all of the option trading that takes place within the firm.
Okay, so now that we understand that three things. I mean, it's up to you. You can do what you want, but greed's not a reason to buy something. Panic's not a reason to sell something. And we don't trade things that we don't understand. And what would cause you to trade something you don't understand? Greed, right? Oh, I don't know anything about oil. I don't think about futures. I don't think about ETFs, but I know this oil thing, I'm going to get into it. I'm going to buy it because it's cheap. Oh my gosh. That is a recipe for frickin' disaster, is when you screw around with stuff that you don't understand. So we're going to talk about what a stock is. We're going to talk about what an ETF is. We're going to talk about what an option is. And we're going to talk about what a future is on a very basic level, because to understand what we're going to talk about today requires a vocabulary of those four things. So let's be as succinct as possible. Corey, what would you say stock is?
Yeah, stock would be ownership in a company, right?
I have some real estate called syndication ownership. And what that means is there's this building, let's say with 257 units, and there's a whole bunch of investors that own this together. And what happens is every month, if this thing makes any money, you have what's called a distribution. And this money goes into all these investors, and it's distributed equally depending on how much or how many shares of this they own. Okay, a stock does the exact same thing. It's ownership of a company. It's not a soft asset. A soft asset is intellectual property. A soft asset is your brand equity. But look, Coca-Cola is every bit as real and physical. Oh, I want to have something I can hold in my hand. Go buy a Coca-Cola and drink it and watch the real money get paid to Warren Buffett, who bought this at $3.50 a share or 25 cents a share in 1985. That's adjusted for splits, of course. It's a real company. If you have a business that's real, and you own all the shares of it, great. If you own some of it, great. So stock is ownership, okay? And we ought to do this while we're at it. What's a bond, Noah?
Well, bond is short for bondage, right? It's a contract that obliges one to another. It's a loan yeah.
So if you buy a U.S. bond, who are you loaning money to, Noah?
U.S. government.
If you buy a corporate bond from Apple, who are you loaning your money to?
Apple.
If you loan money to a municipality, what's that called?
A municipal bond.
They're often tax-free. But if you have anything to do with a bail bond, you live in the wrong part of town. Okay, let's talk about what an option is next. This is traded at the Chicago Board of Options Exchange. And this is an agreement. So an option is an agreement where this guy says, I have or want the choice And Corey, what's another word for choice that starts with an O?
An option.
Yeah, I have the choice to buy something, let's say, or sell. Either one. You can do a buy or a sell. And this guy says, I will make you a promise. So if you make a promise to buy, he will make a promise to sell. And if you make a promise to sell, he will make a promise to buy, or a choice to sell. And these have what's called an expiration date. And this person pays the other guy a premium, like insurance. Now, you don't have to understand anything beyond that right now. Just understand that an option is different than a stock, and a stock is different than a bond. And with this one guy makes a promise, and the other guy has a choice. Fair enough? Anything
Perfect.
you want to add to that? We won't get into strike prices or anything like that. We just know that these expire. It's a limited thing. Bonds expire. That's called term. Stocks, they expire if you go bankrupt. Other than that, there's no date or expiration. Fair enough?
Fair enough.
Okay, now we're going to talk about a future. And a future, I'll just draw two more guys here. A future is almost like an option, except here is this guy makes a promise to buy something, and this guy makes a promise to sell it. Okay, and there's no option. There's just one. It's just a done deal. So it might be like this. Let's say that Noah has corn. He's a farmer, and you have corn, right, Noah? You're growing corn, and Corey is Kellogg's, right? So here's Noah, and as a farmer, Noah would love he would love to be able to sell his corn. And here is Corey, who owns Kellogg's, and he's going to buy corn. So you know he's going to sell it, and you know he's going to be the buyer every single time. So they just make an agreement in the future. And what that does is it helps offset price fluctuation, doesn't it, guys? You can come to agreement. What's nice about this is Noah now, he might take a little bit less for his corn, but he knows he can get rid of it. And Corey might pay a little bit more for his corn, but he knows it's not going to go through the roof. And so now both of these guys can make a plan. Both these guys can make a business plan and have a little bit more stability, they hope. But I'll tell you what, this is really important. If Corey makes a promise to buy this corn, he has to, what do you have to do, Corey? You have to take what?
Take delivery. And I've made a commitment, a contract, right? So I've said, I want delivery of this at a future date. That's why they're called futures.
Yep.
And Noah's made a promise to sell it. So he's going to deliver to me, and I'm going to actually accept that delivery and I guess turn it into cereal.
Well, yeah. So each contract is one train car full of corn. You better be ready to put it someplace.
Now
right.
here's where this gets a little sticky and where you've got to learn a lot in a real short amount of time. There's a stock market where people will trade these. They'll trade the stocks back and forth for money. There's a bond market where people will trade these. So a bond has an expiration date on it, right? You have 10-year bonds, 20-year bonds, 30-year bonds, 1-year bonds, right? They have an expiration on them. But the value of these bonds can go up and down based on the interest rates and supply and demand. So you might buy a bond and sell it to someone else before it hits expiration. Is that right, Corey?
That's right.
And someone else might want to buy your bond before while it still has some time left in it. Well, guess what? Same's true with an option. These guys might, this guy might buy this, pay this guy this premium and buy this choice, and then he might sell it to someone else. Isn't that right, Corey?
You can trade in and out.
He might never take delivery of the stock. And so there's a market for this. Well, guess what? There's also a market for these. Because as the price of corn goes up and down, or oil, or gold, or silver, any commodity, as the price, and all this is, as the price of stocks go up and down, the options go up and down. As the price of commodities go up and down, the futures go up and down. So the guy who made these promises, you might sell your promise or sell your future to someone else. Is that right, Corey?
Yeah, somebody else could come in and take your spot there. So basically, as the price fluctuates, I could say, well, I made a promise to buy, but I'm going to go ahead and sell that to someone else, and they can take my spot, and they can accept delivery of this.
So here's the problem with trading commodities like gold and silver is if you're going to take delivery, you got to store it. So if you want to trade physical gold, well, where are you going to put it? You going to put it in a vault in your house? You know, some people say, well, I want the physical gold in my hand. Well, okay, to a point, but what if you're doing millions of dollars? So a lot of people don't want physical. Now think about what oil is. Oil is toxic, it's smelly, it's flammable, it doesn't last it'll go bad. You know, you can't keep oil forever. It'll go bad, it'll go rancid. It's an organic thing. And so a lot of people would like to be able to participate in the investment of it and the price fluctuations and speculate, but they don't want to own oil. Okay, and if you do own an oil well, you want to be a seller of oil, probably not a consumer of oil. So, for example, let's say that my gas tank was full, and my lawnmower was full, and my jet skis were full, and my four-wheelers were full, and my truck was full, and my boat was full, and all my little gas cans were full. Am I in the market for gas? No, even if it was cheap, because I don't have a place to put it. So we'll get back to that in a minute.
And to your point, Andy, maybe all of those are already full, and maybe you're stuck in your home and you're not planning to use your boat, your car, your airplane, your anything right now, which is where the world's at, right?
Dude,
We're not
it would take Corey. It would take a pandemic to do that.
Yeah, exactly.
I mean, the only thing that's going to stop the world and it's shut is if you had some kind of pandemic going on, right?
And then people might stop using oil, and you might have a problem.
So let's say this. Let's say Russia gets in a pissing, or I shouldn't say pissing match. I apologize. This is going out to the public. Let's say Russia gets in a little tiff with OPEC, and they start to have a supply war where they want to pump so much oil that it drives the price of oil down so far that it drives the other guy out of business. Because think about this. Let's say OPEC thinks that they can get oil out of the ground for $5 a barrel, and they say, well, we can sell it for $50. But look at this. If we think Russia gets it out of the ground for $7 a barrel, what if we drive down the price to $20? That means we're making $15 a barrel, but they're only making what? $13 a barrel. And maybe this breaks them or hurts them, right? Is that how a supply war works?
Yeah, and everybody has different break-even levels.
The fractors don't have a great one.
Some of those countries like Saudi Arabia, I think they can pull oil out of the ground for like $3 a barrel.
Oh, they're like Jed Clampett, man. You shoot a bullet in the ground and up comes a bubbling crude. Exactly. You can't stop it from seeping up.
As opposed to here in the U.S. where the shale drillers, a lot of times their break-evens are at like $40.
That's right.
So when oil plummets, they're losing a ton of money. Saudi Arabia is actually still making some money, or Russia might still be making some money. So you can understand why they can just flood the market and basically destroy the competition. And if they can destroy the competition, once that competition's gone, then oil prices can go up. But right now, I think they're in that spot of flooding the market and really just driving energy companies out of business here in the U.S. specifically.
Now that we understand stock, bonds, a little bit about options, a little bit about futures, let's concentrate on what an ETF is. And all ETFs are not the same. So that's very important to understand, is all ETFs are not the same. And that stands for Exchange Traded Fund. And the key word is what? These mostly are built to trade. They're not all built to buy and hold. They're built to trade. And you can invest in them, but you got to be careful because of how some of them work. And the thing of it is like gold and silver, the way the gold and silver ETF work is a lot of people say, well, that's not real gold. So, well, it's not real gold. It's paper gold. It's different than physical gold, but you'd use it differently. And, it's kind of like my syndications that I'm a part of. That, here's Andy, the investor, and here's really the company that owns it. So I am a shareholder in this company. Maybe I'm part of an LLC, and maybe the company's like an LP, and they control. So I own, but the company controls. So I have nothing as a syndication. I give my money to this guy. The company that really owns this building, that I'm just a part of here, I got a little piece of it here, I don't have any say on what the rent is. I don't have the power to raise the rent. I don't have the power to drop it. I don't have the power to up the distribution. Okay, I don't have the power to sell. I don't have much power there. The same is true with an ETF, you might say, in that they might have a boatload of gold to back up what they're doing. They might be backed by gold, but I can't get delivery of it. In other words, if I own the GLD ETF, I own a share of a company. Okay, I own a share of a company that owns gold. And they actually own, so every time someone buys this and drives this price up, they take the money. Like when I buy the ETF from either another guy or what have you, I get I get a share of that company that owns the gold. And they actually back this with physical gold. Is that true, Corey?
That's exactly right.
But I can never get my hands on the gold.
Yeah, I mean, I think it's only large institutions that would ever have that ability.
You have to have a certain amount. You actually can. Yep. I think it's a huge amount of ounces. Like in silver, I think it's like 5,000 ounces if you want to actually go do that. So
right.
Or 50,000 ounces or something like that. Some ridiculous number. Yep. Okay, but this is different. Now, another one you might have is like the SPY. And they actually have shares of the what?
Of the S&P 500, all
actual shares. Absolutely. Yep. They actually represent those shares. But then you've got other ETFs that don't do that. And one of those ETFs, and it's even funny because people say, well, it's paper oil. Well, it's all fun and games till you have to take delivery and they realize, oh, actually, this is real oil, right? Actually, this is real oil. See, the advantage of a future and the paper is that you don't have to mess with the oil. You don't have to have that sticky, slimy stuff. You can invest in it. You can trade it. You can use options on it. But it's a little bit different. So let's talk about what this ETF does called the USO. What this company does, this ETF company, okay, what this ETF company is they don't buy oil. They buy what, Corey?
They buy futures contracts.
They buy futures contracts. This is very important. They buy futures contracts like this, okay? Now, let's talk about what this future contract does. Is let's say I have a contract for May. And let's say it's April today, okay? And so you have some people that are making an agreement today, right? One makes a promise to buy, which means what, Corey? Take delivery.
Yep.
And the other makes a promise to sell and provide delivery. And
right.
And this guy that sells it might not even have any oil yet. He's just promising, speculating. And if it comes down to it, he might have to actually buy that and deliver it at some point. And this guy will actually have to take delivery unless they do what? Before, let's say this expires on a certain day in May. If this guy doesn't want to have to get some oil to give him, and this guy actually doesn't want to take delivery, what has to happen, Corey, before this expiration?
Yeah, basically they would have to close out that contract, say, I don't want this one, and move to May. Right? They would have to say, well, I need to get out of this promise because I don't want to accept delivery of this contract.
Now, this is the very important part that people need to understand. How do you close out a contract? Because doesn't this require that someone eventually buys this and someone eventually sells this? Or can this contract be created and disappear? Or how does that work? Can you talk about how they get rid of this thing before this day?
Yeah, and so here's basically what happened today. There was a really weird dynamic where and you probably heard, oil prices went negative. And so everyone says, well, how is that even possible? It didn't go negative everywhere in all contracts, but it went negative in this front contract. Because
in this one.
In the very front one. So assume April's gone and we're, right here, or May's gone. I'm just focusing on the front one. So if we're in April right now,
right,
it's basically they don't want to accept delivery of that. And so because they don't want to accept delivery, they're basically liquidating and saying, we want to sell it. Well, the other people are saying on the other side, we don't want delivery either. I don't want it. So prices plummeted because nobody wanted oil delivered at their front door. And why don't you want oil? Normally, there are institutions that want oil delivered to them. But we're in a market environment that's different than any other because airlines are not flying. Bus stations are closed and people are not driving, et cetera, et cetera. So you go down the list of all those that normally have demand and want delivery of oil, and all of them are saying, we don't want it delivered. We don't want these contracts. And so you have all these sellers saying, we don't want it delivered at our front door. And those that owned it are in a panic, and they're saying, if we don't sell it, we're going to have it delivered at us. And so the panic selling of just getting out of contracts, it went negative because they had to pay someone else to accept the delivery of the oil. Literally were willing to pay to get out of it.
This pandemic is huge because some of the best winners in this pandemic are the auto insurance industry because everyone's quit driving. You're home. You're sheltering in place. You're not going into work. You're not going to the movies. You're not going to the NBA basketball game. You're not going to the baseball game. You're walking to the park. I know that I haven't put very many miles on my car. I'm sitting there doing my thing. So Allstate says, we got all this extra money because no one's getting in auto accidents. Let's make a PR move and give some of this money back to the customers in a rebate. Say, hey, you guys aren't driving, we'll give you a rebate. So if they're not driving, they're also not burning oil. And the airlines aren't burning oil, right?
Yep.
And even oil is like, a lot of your clothes are made of oil. Take something that's a polyester and light it on fire, and you'll see it looks like a burning tire. It's made of oil. Right? It's made of stuff like that. So when we stop buying all this stuff, we don't go to the mall because the malls are closed because there's too many people in them. Everyone, all this has a huge ripple effect. So Here's what's the problem here is you've got all of the big containers are full. And all of the barges and ships out there are full. And there's nowhere to put this oil. Now, here's your problem. You can't turn off your pump. And here's why. Think of a farmer. He's got to milk those cows whether he sells the milk or not. Right now, dairy farmers are getting killed because there's just not as much consumption going on of milk. And it goes bad, just like oil does. But a farmer can't stop milking because the cows are on a schedule. And their udders will explode. They'll pop. They'll get sick. And if they don't keep the milk going, it goes bad. The cows go bad. They can't get them started again, or they get sick because they're used to producing so much. So what they do is they milk the cows and they dump it out on the ground and they lose the money. Well, you can't do that with oil because if you burn it, it's an environmental hazard. If you dump it in the ground, it's an environmental hazard. And if you dump it in the ocean, ask BP how that goes. With broken pipe. That's what BB stands for now, broken pipe. And so the problem is how much do you think it costs to get that oil thing going and get that pump going in the middle of the Gulf of Mexico? Well, to shut it off is way expensive because it's so hard to get it going again, just like the cows. And so the oil companies have a choice to make. You can't dump the oil on the ground like a dairy farmer. You can't burn it in the air. You've got to have someone to do it. So what you're going to do is anyone who has any space available, right? Here's oil company A, or actually promised to buyer A, right? The guy that's going to take delivery, he's got to have the place to put this. So if there's an empty one and there's guy A and guy B, he's going to say, how much will you pay me to take your oil off your hands? And it's going to be enough to where an oil company will either shut down. So one thing that could happen, I'm not saying it is, but one thing that could happen is often in the past with commodities like soybeans or corn or wheat, the government will just pay a farmer not to grow. Talk a little bit about that, Corey or Noah, either one. You're both muted.
Yes.
So go ahead.
No, you're good. So basically, the idea there behind this is like paying a farmer not to grow would be just basically a subsidy, just saying, look, we don't need it, but we want you to stay in business and so on. So we're just going to help you along. And the same type of concept could be in the works here for energy companies. You can imagine the pain that they're in right now because their source of revenue is based on these oil prices. And obviously oil prices are just plummeting. And so these oil companies in many cases can and will go bankrupt. And there's a market dynamic there where these things are interconnected. If these companies go bankrupt, that means more people laid off work. And if you have more unemployment, then there's negative side effects to that and so forth. And so, there are no good choices when you get in these situations. They're all kind of bad choices, and you're picking from what you think is the least bad option.
So let's review this. Here we've got a guy that makes a promise to buy, which really means what? Take delivery, right? We should actually write that out. Take delivery, right? He's going to promise to buy. This guy is making a promise to sell, and he has to deliver. Okay, anything you want to say about that, Corey? Anything
and a lot
fun?
of people want to sell, and not a lot of people want to buy. That's the issue right now, right? There's a lot of consumption, and there's a whole lot of supply.
So that's an important thing in this future contract is one guy makes a promise to buy. And the way this works here is, maybe they make an agreement that this guy is going to go here and he's going to say, look, and this is a strike, not a premium. They just say, look, let's say the price is $20 a barrel, right? And they just make that promise to make that exchange at $20 a barrel. That's where it's different than an option. And so they say, okay, $20 a barrel. Well, if it goes to $25 a barrel, right, who's really in really nice shape? This guy is, because he has a promise to buy at 20 and he has a promise to sell at 20. So the intrinsic value of that contract just went up $5. But if all of a sudden the price of oil goes to $15, right? This guy sucks because he's having to pay 20 and this guy would have only got 15. He gets 20. So now this guy wins because now the price of this has gone down $5 from its value. Is that right, Corey?
That's right. And a lot of those people that promised to buy, they did that a long time ago.
Yeah.
Because they were planning for a different world than what we live in right now. So you can understand they thought that they were going to be using a lot of this oil. And as things have gotten worse and worse, obviously it's become quite apparent that they're not. And so they've been selling and selling and selling. And it's a very short-term issue right now. Now, it could linger on, but it's such a short-term issue because right now, like you mentioned before, we have millions of barrels of oil out there, and the short-term consumption is just so low. Maybe things will ramp back up, and maybe things get more normalized later this year. But in the short term, we've got no demand or very little demand and a whole lot of supply. And that's the basis for all of the issues in the oil market right now.
Oop, I got to write that more neatly. I'm writing too fast. Contango is not a disease you get when you do the tango with a coronavirus partner. That's not what contango is. It's not that I was contaminated.
Never mind. That was a good joke. I was going to comment on it, but it was so good.
No, go ahead. Go ahead. Shoot it down.
Well, I was just biting my tongue during the entire cow part, trying not to say it would be an utter disaster.
Oh, my God.
So I had to bring that one back up.
An utter disaster. Oh, do you know what I have to say on that? I'm not going to say yay. I'm going to say moo.
Moo.
I'm going to moo. Bring out the moo birds. Oh, this is bad. This is bad. If the cow lost his legs, what would he be?
Ground beef.
That's exactly correct. There you go. So contango is this. Let's say that we're $21 a barrel here, and we're $23 a barrel here, and we're $24 a barrel here, and we're 20 here. Now, Corey, this is called contango. You're smarter into this than I am on this. Could you explain contango?
Yeah, so in the futures markets, even though a barrel of oil is a barrel of oil, remember there's delivery at different dates. And so contango is normal pricing in that we assume an asset or a commodity is going to get more expensive in the future than it is right now. So if you want a barrel of oil right now, it's going to cost less money than if you wanted to lock in the ability to buy it down the road, right? We would assume that generally prices rise longer term. So July being more expensive than May and so forth. That's normal pricing, and they just call that contango.
Remember,
the further you go out in time, the more expensive that commodity is.
The further out in time, the harder it is to predict where things will be. Like I'm pretty sure that I won't have a heart attack tomorrow, but I'm not so sure I won't have one in 10 years. I'm pretty sure that I won't get cancer tomorrow, but boy, I don't know if I won't get cancer over 10 years. And so the ability, like if you've ever traded options, you're going to pay for time value. You're going to pay for your ability to lock in a price. For like a leaps is expensive. You can buy an options called a leaps, long-term equity anticipation securities. That's a lot of time. You're locking something in for 8 months, a year, 2 years. So you're going to pay more to be able to lock in a price that is longer term. Is that fair to say?
Exactly right.
Okay. Yep. So this is called trading in contango, and this is more normal. Okay. Now, this is a word that I really didn't know the definition of, and it's just fun to say. Okay. I had no idea what it meant. Is what we call backwardation. And that doesn't even sound, that sounds like someone made that crap up. Backwardation. What the heck are you talking about backwardation? Backwardation would be something like that, right, Corey? Where it's backward.
Correct.
It's backwardation.
Backwards to normal. Yep.
Right.
Backwards to normal is basically what it is. Now the short term is expensive compared to the longer term. And when would that happen? Think about oil. When that could happen is if there's not enough supply. So imagine that war breaks out, big explosion happens, and a huge amount of the oil in the market is blown up. And so the market had expected hundreds of millions barrels more than what they're actually going to have in the short term. Prices are going to go backwards because everyone's going to say, whoa, I need oil. Imagine we're in a normal economy. I need my oil. I can't survive without it. So I'm willing to pay because I have to have it in April. And so why would it stay low in the longer term? Because everyone knows that by July, Saudi Arabia and Russia and the US and Canada, we can all increase production. But we don't have enough time to increase production in April.
We need it now.
So it would go backward if you had a big demand shock where demand increased and supply was not enough. That's literally the opposite of what we have right now. We're in massive contango.
Now, there's a word for this. What would this be? What if I put a super in front of this, Corey?
Super contango, yep.
That's what we're in. Did you
just make that up?
No, that's actually a real word.
There you go.
When this contango becomes very, very severe, they can call it super contango. So I'm going to give Corey the conch shell, and maybe we can get into even more granularity here. I like big picture stuff. Let's get into a little detail, though. I'm going to give this to Corey and make him the presenter. If you wouldn't mind, Corey, would you bring up some future contracts on oil and show this super contango?
Let's do it. So it is super contango, and I actually hadn't heard the term super, but I definitely would call this super contango. So here is oil. These are actually, CL is light sweet crude. That's the contract. So that's just a type of oil, and it basically shows the pricing and it shows the month. So let me separate these and just break them down really slowly and just kind of make sure that everyone's on the same page. So I'm going to separate these out a little bit. If we look at what it costs to buy a May contract, that contract is $1.60 to $1.70. I mean,
that's
barrel
like nothing.
Of oil, a barrel of oil down $36 today, down 95% in value. It just absolutely plummeted in value.
Now, the reason this is
short-term contract.
The reason this is so important is a lot of people think, well, if I can buy a barrel of oil at $1.60 and then it goes up, I'll be able to sell it at $21. No. Now, slow down here, Tiger. What does this may mean again? You got to take what?
Delivery.
So the reason this is so low, it doesn't mean that people think oil's not going to be cheap later. It means that I don't want the oil right now. I love oil. That's fine. I had a friend of mine text me and say, hey, how do I get on buying this oil at, these low prices? I want free oil. It's like, dude, you can have oil all you want if you're willing to take delivery of it. You can have that price. You can have the dollar for if you think you can store it. Wonderful. Now, isn't that interesting? Because the smartest trade in the world would be to take delivery of that at $1.60, right? And then wait a month and sell your oil at $21. Wouldn't that be the best trade in the world?
Yeah, and there's actually funds. There's funds doing this, but the problem is there's no more places to store it.
You can't put it anywhere.
Yeah, all of the tankers and all of those, there are some tankers that are floating out there, because what these funds thought is, well, we can buy it here and we can lock in a contract to deliver it here and we'll make the difference.
We'll make $20.
The problem is they don't have anywhere to store it, and this is just showing that the market for it has just plummeted because they're already storing so much that all the tankers are full. The world is literally just drowning in oil at this point. So
you got no containers for it, and it's not like you can just store it in it's a toxic, flammable, gooey, messy material. You can't just put it in a dump truck. You got to put it in an oil tanker. Right. You can't just put it in a milk truck. You can't just put it in your waste paper basket, right? You've got to have special equipment to pump this, transfer it, and store it. And they just don't have it right now, which just says there is not a square inch of cubic volume place to put this stuff.
Yep.
Incredible. Absolutely incredible that we just run out of room. And this is because of a couple of things. The Saudis and the Russians have been pumping this stuff, trying to drive the price down to kill each other off in their other, like we talked about before. So they've been pumping and pumping and pumping. All of a sudden, coronavirus hits out of nowhere. No one's driving, no one's flying, right? Malls are closed. People aren't buying clothes. There's just not a demand for oil. And so it just sits in the tankers. And the problem could be that, all right, so this month there's no place to put it. We're certainly not going to burn it off into the air. How does ExxonMobil not shut down their pumps? And if they shut down their pumps, what happens to their company in terms of revenue, but also in terms of just trying to get it going again? So this is a logjam of a mess. Yes, this could be ugly. You agree?
Yep. Correct. And depending on what demand looks like over the next couple of months, if the world doesn't start to normalize, this can be a ongoing issue here. So we're not necessarily out of the woods next month, because demand, we got to start using that oil in order to work off this excess and get back to a more normalized market. So it could be a long road for energy stocks and obviously for anything that tracks oil. So,
and even if you're empty and you say, well, I'll buy this at $1.65, well, you don't know that those Junes are going to stay at 21.
Yeah.
Because I guarantee you these Mays were not $1.65 3 weeks ago.
Correct.
I mean, it's a huge deal. So what does this have to do with USO?
Yeah, so USO, a lot of people think, well, I'll just buy USO
at $3 or $4,
and I'm going to be able to participate on this huge recovery because I know oil's going to go back up long term, and they're envisioning a scenario where oil goes back to 40, 50, 60 a barrel in the future. The problem is that USO isn't exactly constructed that way. The way that USO is constructed is it holds the futures contracts. That's what it is. That's what it holds. And so we've already talked about that futures have an expiration. So let's do a simple example. Let's say that USO
now let me interrupt here a little bit. USO does not want to take delivery if it buys a contract. In other words, USO doesn't have any place to put this oil. USO's goal is to get everything sold in what we call rolling out to the next month. So maybe you could talk a little bit about that as you cover this. So I just want to make it clear to everybody that they do not want to take delivery. So whatever they buy, they have to sell. Now think about that a minute when in terms of extreme contango. USO is like the VXX in that it's not built to last forever. Someday the USO will disappear because every month they're going to lose a little value if it's in contango. Is that right, Corey?
That's correct. And we have super contango, so they're losing a lot of value. They were a big seller, according to market participants. They were a big part of the problem today, and they're probably going to continue to have problems based on the pricing of these. So what USO does is basically it has contracts, and as it gets close to its expiration, now which expiration is it approaching? May. So as May starts to approach, they want to sell their May contract and replace it with a longer dated contract. So they were in there in the market trying to sell their May contracts and to replace them by buying maybe July. Well, if you're selling something for $1, $2, $3, and as you sell it, you're going and replacing it by buying the exact same product. It's a barrel of oil is a barrel of oil, but you have to pay $27. How good
it's
or
your
bad
business.
Is that? Well, it's horrible, right? Because if you're buying something as a replacement that literally is, and you know, you think about it in terms of the asset, you're just replacing. It's like
you're selling your oil at $1.55 and then trying to buy the next oil at 27. Right?
At 27 or at 21, and then imagine let's just say that they bought June 1st. So they buy June initially. So the math on that is horrible. Let's say they sold at an average of $2 or whatever, and then they buy June at an average of $21. Yeah. They just lost $19 in the process. So they lost 19, but it doesn't even get better for them because even if prices stayed the same, what would happen when they had to sell June? Well, if they got 21 and they had to replace it with July, they're paying 27. They're still losing 6 on that. So that's not as bad a contango, but it's still really, really bad.
That's fourth.
Every time they're rolling it out, they're just losing value. They're replacing a barrel of oil with a barrel of oil, but they're losing massive amounts of money every time they roll those contracts forward. So when you have this dynamic like we have in the marketplace right now, USO is a very dangerous asset because it's literally just bleeding capital. It's just bleeding out money.
And what will happen? Go ahead, Noah.
Oh, I was just going to say, this raises the question in my mind, is that fund going to be dissolved? It reminds me of the XIV back in 2018.
Yeah, same thing happened with that XIV, which is just basically when you get these issues, Any asset, any ETF or ETN as they call them, that are backed by futures contracts,
it'll go away.
You have to be very careful with them. That they're different than SPY. SPY is just stock shares, right? It holds the stock shares. It's fine. If it's backed by GLD, which is backed by gold is just sits there. You don't have to constantly use it and replace it and use it and replace it. These are a problem, and the problem is that oil can't just sit there. It has to be used. In order for them to use something that tracks it, they basically have to use the futures, and this whole pricing mechanism is just a huge deterrent. I mean, it just loses their value considerably. There's another one in natural gas that's called UNG, and it's just as bad or worse, and it just does the same thing, but on natural gas prices. There's huge contango in that, and it's just bleeding out money. So
you look at the VXX, that VIX. They actually told their shareholders, they say, we think this thing will probably be gone in 2018, 2019. These are things you could short. The problem with shorting them, though, is if you do have a spike, then you might get a margin call, right? But if let's bring up a chart of the USO long term, shall we? And just look at it. Shall we do that?
Yeah, I can pull it up.
Bring
right
up like
here,
lifetime.
Long-term.
Yeah, lifetime of the USO. And this isn't. Yeah.
Weekly chart, and we'll just go back. I don't know.
Many years as it will. It probably hasn't been around 20 years. There it is.
2005.
Okay, and now take it out of logarithmic scale. Okay, there you have it. So, from $120 down to $10. And if you'll notice, this hasn't really even traded close to a barrel of oil. I mean, look at 2015, 2016. This has been under 20 for 5 years. Why? Well, contango, correct?
Yep.
That's why.
Even as oil had some recovery periods, like oil went back to, 40 and 50 last year. Well, this never participated in a meaningful way because it just kept having that bleeding out. And you mentioned VXX and some of those. These are just to be avoided. I mean, I'll show you some extreme examples. Look at something like UVXY. Again, this is a futures-based ETF, and of course, this didn't start trading in 2014.
Yeah, it wasn't a 990K. It reverse split.
It shows you that every $190,000 originally invested is only worth $51 today. And look at how it's just flatlining down here. Yeah. I mean, it even when there are volatility spikes, think about it. We had the biggest volatility spike this year since 2008, and it barely budged.
Yeah.
That's the contango. That's that deterioration of these assets. So you have to these could be trading instruments, perhaps, but they are definitely not investment instruments. And if you're going to even trade them, you should be very, very familiar with how they work and the mechanics of them. And for most people, it's just a no touch. There's better things to trade. If I have a view on oil, I'd much rather trade Chevron.
And I just want to tell someone something. I just want to tell that little voice inside your head that says, I'm going to short this. Okay, remember that greed I started with at the beginning? Remember that little conversation? Well, I'm going to short this. I knew the market. This is the first time I've ever heard Andy and Corey and Noah speak, but I think I got to analyze. I'll just short this. Let me tell you, do you think other people might have thought of that before you? Okay, so there's probably a reason. And part of it is if you go heavy short on this and it does have a spike relative to where you are, it can hurt you. Is that right, guys?
Exactly right. And to your point, let me show you, it hardly looks like it budged on the long-term chart.
Short term,
let's come into the short term, and it probably went up 100%. It was a drop in the bucket. Well, there you go.
There's your,
it was
we didn't refresh it. We didn't see that.
Yeah, We're still stuck. Very meaningful in the short term. Let me show you.
There you go.
There we go.
Yeah, you want to be short that in March?
Yeah. And so long term, it went from 190,000 down to 50, and it looked like it didn't budge. In the short term, when we had that massive volatility spike, it went from 20 to 130 and now back to 50. And long term, it probably is going to continue to dwindle, but it can have some massive spikes in between.
So let's go back to USO. And hopefully, if you haven't been able to follow this, that's fine, because we had to talk about futures and options and contango and backwardation and rolling forward and rolling out. Now, here's one thing that Noah can talk about that's a big deal is, Noah, there are still reasons to use this as an instrument, but not as an investment, as Corey said. Talk about how, the USO might be important, or talk about this from a guy who adjusts trades and thinks about trades, what you think about the USO. Because you and I used to sell puts on this all the time, and it started getting put to us, and when it'd go up, it really didn't. We started noticing that contango taking effect. We're like, man, we're not getting the rise out of this. Time to move on. You want to talk about that a little bit?
Well, yeah, just that. I mean, for a while, it was actually a pretty useful cash flow instrument. With these types of ETFs, it works until it doesn't. And a lot of times they just do reverse splits on it and they adjust it and it'll bump prices back up. And so it'll reintroduce premiums that work, and it kind of fixes the wiring a little bit, so to speak. But eventually, if it hits a super contango, apparently that's enough to cause a problem. And this is not the kind of thing, if you had talked to me 10 years ago, I would have thought this was probably something you bought and held.
Yeah.
Because I didn't understand. I'm like, it just tracks oil, and if I think oil is going to go up, that's probably a good way to go. But as I traded it and I started to see, at certain points in time, something can really be traded. You could trade it as a day trader.
Yeah.
You could trade it as a swing trader. You can sell options on it. You could cash flow on it, as long as the premiums really make sense. And we noticed the same thing with the SLV, Andy, is that for a while, it was a pretty good little trading instrument for selling options and collecting premium. But that one, in theory, is, of course, backed by silver, but it's had similar issues where
that's a big deal, because now, and maybe, Corey, you can speak to this a little bit, is there's quite a divergence between spot price and paper price.
Yeah, that's exactly right. There are some weird dynamics, and I'm not sure exactly how that's working. You mentioned SLV and GLD. We've, as a group, we've been reading up on that and trying to figure out, okay, how are spot prices and this kind of diverging. It's kind of interesting to look at those precious metal markets, and there are some dislocations. What's odd about that one is that it could be a dislocation where there's not enough of what's supposed to be there. So it's kind of like a run on gold.
It is, because people want it now.
Not enough gold to be delivered, and so everyone panics. And so silver and gold, you might have the opposite dynamic from what I'm reading anyway, where that could really be upside potential.
That's
where
right.
People say, there's kind of a panic that there's not enough.
That's right.
I've actually talked to a few of my friends who are gold dealers. They're actual brokers, and they told me that it's tenuous at best to try to get your hands on any of the physical. The mints are out. They're on back order.
Yeah, 12 weeks.
So, there is a real shortage. Yeah, absolutely.
And there's guys, and the truth it is, those guys are going even above spot on gold dealers, right? I mean, they're going above spot big because they can price gouge. Usually you're going to spend $100 to $130 an ounce over spot. I've seen guys going $240, $200, right, over spot. Oh, yeah, absolutely. And they're getting it. So let's go to ExxonMobil. And, now we have to look at how this is a stock. And you can see they didn't have tremendous damage today, right? They kind of had a little bit of a harami, one inside the other, kind of an interesting type of lower half harami. Noah, talk a little bit about this. If you own this stock, what are some things to think about, in terms of oil, or, the OIH is another oil holder, XLE. I mean, there's a lot of stuff, but this is ExxonMobil. How could a person protect themselves if they wanted to hang on to this and still get the dividend if there is any left, but what if a person doesn't want to sell it? They want to keep it. How would you protect yourself?
Own that stock. You can own that stock, and you can use the options to protect it. You can buy protected puts, which would be an expense, and they're probably on the high side right now. Collar the stock. You could sell calls to pay for those puts, and you wouldn't make money on gains or on the stock price moving. You'd be neutral if you did it right. But you could still collect the dividend.
So I like this idea of what's called a collar. I really like that idea, because what you're going to do is you're going to sell some calls to finance your puts.
Correct. And they could potentially get you called out where you would deliver the stock, but you would deliver it at a higher price or a price you agreed to.
Let's go to the options chain on USO.
Okay.
Let's talk about that, Corey.
You want that on USO?
Yeah.
Or
do you have it? Yeah.
Mobile?
No, USO.
Yep.
Let's look at the options on USO, and let's look at the most recent options. Like the most recent, like April. Yeah, like 11 days from now. Or, let's look at the May 1st.
24th.
Let's look at the May 1st. Yep, just for fun. Now, right here, the at-the-money options are around 4 probably and change, or somewhere 3 and change.
Like 375, so it's right in the middle of there. Call it 4 or 350.
Okay, Noah, if you were going to be forced to trade this, what would you do? Is there opportunity in here? Do you just turn and run? What would you do if I made you do a trade here?
Oh, I wouldn't be real happy with you, Andy, if you made me do a trade on this. I'm feeling the pressure. This is one where it's a new territory. I'm not familiar, and I want to bring you back to what somebody said earlier. If it's something you don't understand, you shouldn't trade it.
I love it.
Not that I don't understand the USO. I do, but I don't understand this environment well enough. I've never seen this before.
Beautiful.
So I don't know how it's going to behave. So I would abstain.
You know what? I might look at maybe a bear call spread that's way out of the money.
Well, yeah, and that's certainly something you can do. And the thing is I could do that and know how to hedge it. And if it ran up. So for me, I could trade it, but I would rather trade something I had a little bit more control on. But yeah, you could do a call spread, a put spread, if you thought it was going to go up, if you thought it was going to go down. And as long as you knew how to exit the trade, limit the risk, take a loss if it ran against you, just keep it small before it got big. That would be important. But yeah, you could trade it, but I'd rather go trade ExxonMobil.
Let's go big picture for a minute. I love this. It works until it doesn't. Let's pull this off so it doesn't confuse everybody. And let's just do a little bit of review. An ETF is a company that tries to track the price of something else, whether it be a stock, a precious metal, and in the case of USO, it's trying to track the price of oil. The way the USO does this is not by taking physical derivative. Gold is pretty easy to store because it doesn't need to be repumped and consumed. It's not a consumable. Gold is not really consumable. Silver, maybe a little bit of a consumable. Gold, not so much. I mean, you can make some computer components with it, and some circuits with gold, I guess, and maybe make a watch or two out of it. But really, gold can just sit there. Oil can't. It's got to move. Therefore, the USO ETF is different than the GLD ETF. Corey, anything? Okay, then we said that a future is a promise and a promise, and that these the prices go up and down of the future based on the price of the commodity itself. We talked about the idea that the problem right now is oil is still valuable. It's just nobody wants to store it right now or can store it. And like a farmer, you got to keep that cow going, and you got to move that oil. So we might see some government step in, and we'll see if they do, which would not be unprecedented because they pay farmers not to farm all the time. But it's something to think about. We talked about what an ETF is. We talked about what a future is. We talked about contango, backwardation. Way too much for one session. But, I'll just say this. Can I do a little advertisement, guys? Is that going to offend anybody? Listen, my message is really simple. If there was ever a time for someone to get serious about their financial education, when would it be? Well, it would have been 6 months ago or a year ago. But you can't go back in time. And so a person has a couple of choices. They can put their head in their sand and just pray and hope things work out, or they can start to learn. Obviously, this, some people say, well, I'm not going to take piano lessons because I don't play the piano. Why do you think you take them in the first place? So if you didn't follow this and this was drinking from a fire hose, well, please forgive us. We did our best, but this usually takes a little while to learn. And I'll just give a little plug for financial education that if you're not in the 4 Pillars class, get there. If you don't understand options, get there. We don't often talk a lot about, futures and ETFs, so this was a good opportunity for us to do it. But that's what I have to say. So final words, Noah, and then final words, Corey. What do you got to say, Noah?
Well, this was a lot of fun. I really enjoyed the conversation. I feel like I learned from it. If not a better way to teach something with the simplicity of it. I think that was extremely helpful because my phone's been blowing up too, Andy, with a lot of people expressing those emotions of fear of missing out. They got the greed going on and they want to know what to do. But again, if they're looking for advice, it's got to be the same as you gave. Make sure you understand what you're doing. Make sure you understand what you trade.
Don't let that greed. Well, I'll finish later. What do you have to say, Corey?
Well, I was going to kind of chime in the same thing that you guys have said, which is, don't feel those emotions overwhelming you. And so I would say as a general rule, a lot of times it's kind of like when the cab driver starts telling you about the stock he's buying and everybody loves it, it's probably not the best buying opportunity. I think the public universally kind of feels like oil's a huge buying opportunity because they don't understand the supply and demand dynamics. And so being in cash is a worthwhile position if you don't know what's happening in these markets. And if you're going to get involved, probably waiting for the dust to settle before actively taking an investment opportunity or things like that, or at minimum really playing it safe and careful in these markets, because I loved what Noah said. We've never been in this type of market environment before, specifically for energy. And if there's one sector that's been hit from all sides, it's the energy sector. They've taken it on the chin from all angles. So it's a tough market to trade right now. And I just think there's easier ways to do it in a lot of the other sectors. So.
I'll just say this. I'm going to finish how I started, is if you're attracted to the USO and attracted to oil, attracted to all this, and you feel there's an opportunity, but you don't know what it is, okay, what feeling is causing you to do that? Are you afraid of not making money on the USO or not making money? Are you afraid of not taking advantage of a move up or down right now? Because if you are, what emotion is that? Right? That is what greed is. Greed is what drives you to get involved in things because you really want to cash in, right? Every time you see a episode of American Greed on CNBC or wherever you watch it, it's because someone really, really wanted to make a score and they were willing to do things that were crazy to get there. Whether those crazy things were illegal or were those crazy things, giving your money to Bernie Madoff. Look, the guy's last name was Madoff, okay? Madoff, that's a clue right there, okay? Yeah. You give your money to a guy named Madoff, he's going to make off with it, I'll tell you that. So that's how these guys prey on people, and that's how people lose their money. So be very aware of fear, be aware of, and I'm not, look, Andy, you're saying I'm greedy? No, I'm not saying you're greedy. I'm saying you're a human being that loves the Garden of Eden, that loves the idea of, hey, there's an opportunity here, and I don't want to miss out on it. But here's the thing. If you take a Warren Buffett approach, right, and you look at a company like Coca-Cola and you say, are they probably going to sell soft drinks long term? I probably get a dividend and make it through this thing and just make nice, consistent dividends, nice, consistent rents. Okay, maybe someone doesn't pay rent for a while. Fine. As long as you don't lose your building, you're okay. There's too many consistent ways to compound at, good percentages than to try to make the double your money score when you get excited, stuff like that. So this is a little lesson on temperament more than anything else. If you didn't understand the contango lesson, understand the temperament lesson. If you didn't understand the futures lesson, understand the don't invest in stuff you don't understand lesson. If you didn't understand the backwardation lesson, understand the fear and greed lesson. And so if you feel like now's the time to get smart, then come to the Cashflow Academy and see what we have to offer. We're delighted to help teach you. But that, I just have to thank, it's an hour and a half, 90-minute discussion. I have to thank Noah. I have to thank Corey for, bringing their expertise to the table. And so we had a chance to talk about some really interesting stuff. So guys, thank you, Corey. Thank you, Noah. And, everyone be safe out there, be healthy. I don't know that there's a better time to get educated myself. I'm certainly in overdrive learning mode about monetary policies right now because we're printing so much money. And I think you should join us in that quest, but that's just my opinion. All right, guys, that is ETFs, futures, and oil. Thanks for joining us.